Today, the U.S. stock market moved lower, but not because of panic, breaking news, or unexpected headlines. At first glance, the move looks confusing. There was no major negative economic data, no shock from the Fed, and no geopolitical escalation. Yet SPY and QQQ both sold off, while Treasury yields moved higher again. In this video, we'll break down what actually drove today's market move, why tech stocks were hit harder than the broader market, and what investors are really reacting to beneath the surface. This is not about predictions. This is about understanding market behavior.
Let's start with SPY, which tracks the S&P 500. Early in the session, the market tried to stabilize after recent strength. However, as the day progressed, selling pressure slowly increased. This wasn't a sharp sell-off. It was a controlled, steady decline, which is important. That tells us this move wasn't driven by fear. Instead, it reflects position adjustment. Large investors were not rushing for the exits. They were reducing exposure, especially after recent gains. Volume confirms this behavior. No panic spikes, no aggressive capitulation, just consistent selling into rallies. This type of price action usually signals distribution, not crisis.
Now, let's look at QQQ, which tracks the NASDAQ and tech-heavy names. Here, the weakness is much clearer. Tech stocks underperformed the broader market, and the selling was more aggressive and more directional. Why? Because tech remains the most sensitive sector to interest rates. When yields move higher, future earnings are discounted more aggressively, and that hits growth stocks first. Today's QQQ move shows lower highs, sharp intraday breakdowns, and weak rebounds. That tells us investors were selling strength, not buying dips. This isn't panic selling, it's risk management. Now we get to the most important chart of the day, the 10-year Treasury yield. While stocks were moving lower, yields were moving higher again. This matters because yields act like gravity for equities. Rising yields mean tighter financial conditions, higher discount rates, and less tolerance for expensive valuations. Even a small move higher in yields can create pressure across equity markets. Today's yield action explains why. Stocks struggled to hold gains, tech sold off faster, and buyers stayed cautious. This is not about fear, it's about cost of capital.
So what is the market telling us today? Not that a crash is coming, not that the economy is breaking. The market is pricing in higher for longer rates, tighter conditions, and less room for speculation. This kind of environment leads to choppy price action, not straight-line trends. Until yields stabilize, equities, especially tech, will continue to face resistance. The market isn't reacting to headlines. It's reacting to structure, rates, and positioning.